The Bank of England, often called the Old Lady of Threadneedle Street, is the UK's central bank and has played a crucial role in the nation's financial system since its founding in 1694. Over the centuries, it has evolved from a private institution to a public authority, now responsible for maintaining the stability and integrity of the UK's economy. Its iconic headquarters on Threadneedle Street, in the heart of London's financial district, is a symbol of trust and economic stewardship. The bank's core mission is to keep inflation low and stable, while also ensuring the safety and soundness of the entire financial system. This means making decisions that affect not just banks and businesses, but every household in the country. One of the most powerful tools at its disposal is the bank rate, its official interest rate. This single figure has a ripple effect across the economy, influencing the rates at which banks lend to each other and ultimately to consumers and businesses. The bank rate acts as a benchmark for all other interest rates in the UK. When it changes, it affects everything from the cost of mortgages and loans to the returns on savings accounts. For homeowners, a rise in the rate can mean higher monthly payments, while savers might see better returns. Decisions about the bank rate are made by the Monetary Policy Committee, or MPC. This group of 9 independent experts meets 8 times a year, carefully weighing up a vast array of economic data and forecasts before making their decision. They look at factors like inflation, employment, wage growth, consumer spending, and even global economic trends. Their goal is to keep inflation close to the government's 2% target, balancing the needs of borrowers and savers alike. The MPC's decisions have a direct impact on the cost of living, the affordability of borrowing, and the incentives for saving. Whether you're buying a home, running a business, or simply managing your household budget, the bank rate touches every aspect of daily life. As the December 2025 meeting approaches, all eyes are on the Bank of England. After a long period of stability, there's growing anticipation about whether the MPC will signal a change in policy, one that could shape the economic landscape for years to come. An interest rate cut means the MPC lowers the bank rate, making borrowing cheaper across the economy. Even a small cut, like 0.25%, can ripple through the financial system. The goal? Stimulate growth by encouraging businesses to invest and people to spend. Cheaper loans and mortgages can boost the housing market and business investment. But lower rates also mean savers earn less, and there's a risk of inflation rising if demand outpaces supply. The MPC must balance supporting growth with keeping inflation near 2%. A rate cut signals the bank believes the economy needs support, and inflation is less of a threat. It shapes expectations for businesses, investors, and households. The upcoming December meeting could mark a significant change in the bank's strategy. As the December 2025 MPC meeting nears, most analysts expect a modest 0.25% rate cut, from 4% to 3.75%. This would be the first cut in a long time, signaling a shift from fighting inflation to supporting a slowing economy. The move follows a dovish hold in November, where the MPC hinted at growing concerns about stagnation over inflation. A small cut is seen as a cautious first step, providing relief to borrowers without alarming markets. The bank will watch closely to see how the economy responds before making further moves. This measured approach is typical in uncertain times. The expected cut isn't a dramatic reversal, but a logical next step as inflation pressures ease. All eyes are on the bank to see if it delivers on these expectations. The main reason a rate cut is on the table is that inflation is finally cooling, offering a glimmer of hope for households and businesses alike. For months, the UK has grappled with stubbornly high prices, squeezing family budgets and putting pressure on companies across the country. Now, there are clear signs that the worst may be behind us. After months of surging prices, recent data shows inflation rising much more slowly. The pace of price increases has eased, and the cost of everyday essentials is stabilizing. This shift is a welcome relief for millions who have felt the pinch at the supermarket and at the petrol pump. The job market is also showing signs of cooling. There are fewer vacancies than before, and wage growth is moderating. This reduces the risk of a wage price spiral, where rising pay pushes prices even higher. While some worry about job security, a steadier labor market can help keep inflation in check. Government policies are playing a crucial role too. Support for lower energy bills, in particular, is helping to bring headline inflation down. By capping energy costs and providing targeted relief, The government is easing the burden on households and making it less likely that energy prices will drive inflation higher in the near future. Analysts say these measures could directly lower inflation by 0.3 percentage points in 2026. While that may sound small, every fraction counts when it comes to the Bank of England's targets. These incremental improvements add up, strengthening the case for a change in monetary policy. With inflation easing, jobs cooling, and government support in place, the case for a rate cut is stronger than it has been in years. The economic landscape is shifting, and policymakers are watching these trends closely. The urgent need for high interest rates has faded. Now the focus is on preventing the economy from slowing too much. If rates stay too high for too long, businesses may struggle, and consumer spending could weaken further, risking a deeper downturn. The Monetary Policy Committee now has the justification it needs to start easing policy. Their challenge is to strike the right balance, supporting growth without letting inflation flare up again. As the Bank of England prepares to shift from a restrictive to a more supportive stance, all eyes are on how these changes will shape the UK's economic recovery in the months ahead.
The decision to cut rates is expected to be close, a predicted 5-4 split on the MPC. The four dissenters, including Chief Economist Hugh Pill, will likely argue inflation is still above target and risks remain. They'll want to see more evidence before easing policy, fearing a premature cut could reignite inflation. The narrow vote highlights deep divisions and uncertainty about the right path forward. A split decision signals future moves are far from guaranteed. Markets will watch the vote and the bank's guidance closely for clues about what's next. Each meeting will bring fresh debate as the committee weighs risks and data. The bank's communication will be as important as the rate decision itself.
A rate cut has real effects for people across the UK. Borrowers with variable rate mortgages will see monthly payments drop, freeing up cash for other needs. Cheaper loans and credit can make big purchases or debt consolidation more affordable. For savers, though, lower rates mean smaller returns on savings accounts and ISAs. Retirees and others relying on interest income will feel the pinch. The bank faces a tough trade-off. Helping borrowers means hurting savers. For the wider economy, cheaper borrowing can boost business investment, hiring, and growth. It can also support the housing market. But if demand rises too fast, inflation could return. The challenge: stimulate growth without reigniting the cost of living crisis.
Despite the headline, markets are unlikely to react strongly to the rate cut itself. That's because traders have already priced in a 0.25% cut. Everyone expects it. The real action will be in the details: the vote split, meeting minutes, and the governor's press conference. Currency markets, too, have adjusted, so the pound isn't expected to move much on the news. The key question: is this a one-off cut or the start of a series? Any hints about future moves could shift markets more than the cut itself. If the bank signals caution about further cuts, traders may scale back bets on rapid easing. The drama will be in the nuance, not the headline.
The December cut is likely just the start of a new phase in Bank of England policy. The bank will stress a cautious, data-driven approach, no promises about future cuts. Analysts expect gradual quarterly cuts through 2026, possibly bringing the rate to 3.25% by mid-year. But this depends on inflation staying low and the economy needing support. The MPC's close vote shows there's no clear consensus on the path ahead. If inflation or wage growth picks up, the bank could pause or slow cuts. The bank will watch inflation, jobs, and growth data closely, adjusting policy as needed. Investors will scrutinize every statement for hints about future moves. The Bank of England is poised for a major policy shift at its December 2025 meeting, a moment that could mark a turning point for the UK economy after a long period of high interest rates and economic uncertainty. A 0.25% rate cut is widely expected, thanks to easing inflation, a cooling job market, and a series of government measures that have helped households manage rising energy costs. These factors have combined to give policymakers the confidence to consider loosening monetary policy, even as global economic conditions remain volatile. The decision will likely be contentious, passing by a narrow margin and reflecting ongoing uncertainty. some members of the Monetary Policy Committee remain cautious, worried that inflation could flare up again or that the economy might not be as resilient as hoped. For borrowers, it's welcome relief. Lower rates mean reduced mortgage payments and cheaper loans. But for savers, it's a challenge, as returns on savings accounts and fixed income investments may fall further. Markets have already priced in the cut, so attention will turn to the bank's guidance and future outlook. Investors and analysts will be listening closely for any hints about the pace and scale of future rate moves. The key: watch the vote count, the MPC's tone, and any signs of division among policymakers. A split vote could signal uncertainty about the path ahead, making future meetings even more important. The governor's press conference will be crucial for clues about what's next. Journalists will press for details on the bank's thinking, and any subtle shifts in language could move markets. Future decisions will depend on inflation, which remains a key concern. If prices start to rise again, the bank may have to pause or even reverse course. Jobs and growth data will also play a critical role. A strong labor market and robust economic expansion could give the bank more room to cut rates, while signs of weakness might prompt caution. The bank is taking a cautious first step, testing the waters before making any bold moves. This approach reflects the delicate balance between supporting growth and keeping inflation in check. Future moves will be guided by the data, with each new report on prices, employment, and output shaping the bank's next decision. For now, all eyes are on the December meeting, but the story doesn't end there. The bank's journey will continue, one meeting at a time, as it navigates an uncertain economic landscape.